So we have an R&D tax credit question.
Ah,
Yep. So a client wants to know, how can I leverage the R&D tax credit for my small business or startup company?
so I had that reaction because the R&D tax credit has been screwed up lately.
That's true.
All right, so this is section 174. So here's the general idea is that if you have it's called the people call it the R&D credit, but it's actually the credit for increasing research activities. So
Okay.
there's a couple different categories of thing that apply. But basically if you're creating new products, new processes, new software, all that kind of stuff, those are all qualify for increasing research activities. And if you're a scientific company that is doing like what most people will call scientific research, that's going to obviously qualify. But a lot of companies are not doing what we would call science, but do qualify for research, just because the way it's defined is just new processes, products, and all that kind of thing. So depending on what the business is doing, then it very well might qualify. The problem with it is that the specific category of developing software products is has been the language around it has been changed. In fact, maybe what I'm going to do actually is I'm going to bring up the code. You go over here. Let's go to now law, and I want, let's see, amortization of research expenditures. Okay, so let's go back over here. All right. So this is the way the law is written, and there are special rules for some categories. The one we see the most of is software development. So for the purpose of this section, any amount paid or incurred in connection with the development of any software shall be treated as research or experimental expenditure. And the treatment that it has to go through is a 5-year amortization. And this language kicked in 2 years ago, I think. So what ends up happening is that the let's say you have $100,000 of expenses that qualify. So that 100,000 gets split up over 5 years. And then, so you get 10,000 in the first year. It just assumes everything goes to mid-year. It's called a mid-year convention. And so you get 10,000 the first year, 20, 20, 20, 20. So that's 80 over the next 4 years, and then 10,000 off the last year. So it starts in the middle of this year, and then it ends in the middle of that last year. And so the difficulty there is that you don't get to deduct the 100,000. You only in year one, you're only deducting 10. Now you do get a credit for the 100, which usually works out around 6%. So there's some variations depending on time in business and all this kind of stuff, but usually around 6%. So you get if we have $100,000, then we have a $6,000 credit, and we have a $10,000 deduction from the amortization. And so we've got that's okay, but it's not as powerful as it was before this rule change of, I think it was 2 years ago. And there has been legislation introduced in Congress to fix this, to turn it back to the way it was, because plenty of Silicon Valley types have complained to Congress about it and how it's really harming them because they still have the cash flow expense. They still have to pay the 100 to whoever their server costs or developers or whatever, but they're not getting the tax benefit from that spending, at least to the same degree as they used to. So it's put a crunch on a lot of companies that are, very influential and have a lot of money. There has been legislation introduced to fix this issue, but to date it has not passed. They said they were going to. It passed the House and it's stuck in the Senate. We'll see. The R&D tax credit was a lot more powerful up until recently, and it might become more powerful again soon, depending on what Congress decides to do. But that's the current state. Fundamentally, the answer to the question, though, is you identify your research expenses, and then different categories of expenses have different percentages applied to them. So contractors versus employees and stuff like that. And then you go through a formula. There's a simplified credit and there's a not simplified credit. And usually you want the not simplified one. It's more powerful. And then you end up with an amortized deduction, and you end up with a credit. So that's the process by which you go through. But in terms of net impact, not as powerful as it used to be. And we're still hoping Congress will fix the problem that they made. Because this is part of a larger context in that the Tax Cut and Jobs Act was passed at the end of 2017, and it was a 10-year tax plan. And the reason for that is because when they pass legislation, the Congressional Budget Office does a 10-year impact study. Say, okay, if this law passes, then over the next 10 years, it's going to have this effect on the budget. And in order to get that report to come out attractive, they had to do a bunch of weird things. People who lost the ability to, everybody lost, but it only mattered to some people who lost the ability to deduct their state and local taxes. So if you're a high income earner in New Jersey, New York, California, one of these high tax states, your state and local tax deduction is limited to $10,000. So if you're a Facebook employee and you make 400 grand and you're living in California and you pay like 80 grand in California taxes, you get 10, right? And that extra 70 is that's just, you're out of luck. So that was one of those things that was to quote unquote pay for the other tax cuts that were passed. Some of the other things that were done was that provisions that started off strong in the tax code were attenuated towards the end, and we're in that ending phase now. So bonus depreciation is decreasing. We had the R&D tax credit change that kicked in 2 years ago. So there's a bunch of like weird gotchas with that. Now, I don't know if you guys noticed, but it's looking like Trump is going to get reelected. And so if that happens, then it's a political question. It's okay, if Trump gets back into office and there's enough Republicans in the House and the Senate to pass some legislation, then it's highly likely that whatever tax issues that are expiring or are not as advantageous as they were are going to get renewed or reintroduced or updated for the next however many years. That is a very real possibility that we're looking at. And you can't rely on anything because you can't rely on anything until it happens. So this tax bill that was introduced in January to fix these R&D problems, for example, passed the House. Senate said they were going to pass it, and then they got distracted by Ukraine war stuff and whatever. So you can't rely on the politicians, basically. But there's a strong chance that things will get improved as we go into the expiration of the Tax Cut and Jobs Act, which is the date of the reform back in 2017. So yeah, and that's just another level of it depends.
That's true.
In that it will depend on the political context that will apply in the following years for the R&D credit specifically, as well as a few other things.
Understood.
All right. So that's my it depends answer.
Understood. All right, Neil.